about them, but I should say that I strongly encourage you to interrupt me if you don't understand or you find errors, as many of you found yesterday if I didn't say anything. And also it's okay to ask questions in the middle. I mean, that's what I'm used to. So I prefer that mode to just lecturing and then hearing the questions all at the end. So please do ask questions. So yesterday was about the first stage of this. We are interested in what I'm going to talk about today. That's kind of where I was headed, which was the question about the supply of liquidity. But for supply of liquidity to be relevant, you need a demand for liquidity. So the demand problem was something that was the subject of yesterday's lecture, and one of the points I try to emphasize is that in standard neoclassical models there is no demand for liquidity, really, and so that's the idea. There are many ways of creating demands for liquidity. I try to give the absolutely simplest model we can think of, with the idea that it would be kind of a useful laboratory for asking more complicated and sophisticated questions. In that laboratory, the key element was there is something that cannot be pledged in terms of the income stream and of a project, and that's all we are in some sense going to assume. And it's a very simple, kind of minimalist, little variation on the very traditional model which allows everything to be pledged. And I'm going to talk then also later a little bit of why this is actually a pretty flexible lab. But I think you understand that when we have this little picture with the wedge, you can do various things with it. You can say it's bigger, it's smaller, and so on. You have various reasons why that's the case by looking at the underlying moral hazard problems and so on. And as I said, the best testimony of how flexible this kind of instrument is to go and look at that monumental boat of Tirol's that shows you that you can certainly do things with this model. And I think also get insight. The supply problem is the opposite one, and the essence of today's talk will be two things. One of which is to say that this problem that says that it's difficult for this entrepreneur to get perhaps funding because there is something he is not able to pledge to the investors, is also going to be, this very problem is going to mean that this amount here, which is the amount that he can pledge, and the financial instrument, that the financial claims on the income stream that will be available, it's going to be the case that if this is very small, there will also be very few instruments of saving in the situation that you want to actually, the investor side will have the problem that they cannot make the pledge to finance future liquidity shocks. So it's kind of the reverse problem of the demand problem. The demand problem is going to say there's very little wealth that can be used to back up promises of future supply of liquidity or savings instruments. I will give various examples. And so it feeds back into the question, is there actually enough instruments in the economy to supply, to support the kind of plan that I described yesterday? Remember, the plan was that we had this simple thing where we had zero. I'm going to work with the same model, and we have this C0 and 0 and C1. Same picture as there, and the key was that I'm going to go with a two-shock case where there's a low shock and a high shock. And I'm going to assume that the condition which was needed, and you never saw why this is not important, I just write it down that there is a condition. When this holds, you will want to meet both of these shocks. If we are talking about just meeting this one shock, the low shock, that's not an interesting case because that's a self-financing shock because the investors as well as the entrepreneur wants to continue, regardless of how we got here, we want to continue if CL hits, because it's for both sides a positive NPV project. So we are working in the case where our focus will be on the question of how to provide liquidity for the CH shock. And we just assumed yesterday that somehow investors have the ability to provide it. And what the supply of liquidity is about is to say this is actually not a trivial case to cover this shock, because it's not self-financing. That is, if you ended up here by accident, whatever way, this is the most you can give the outsiders, so they are not going to give you CH. If you don't have it by now, you are not going to get it, because it's more than the most you can promise them. And then the question is, how are you going to get that commitment to supply CH? That's going to be the problem that we are interested in. So we are no longer going to assume there is this happens somehow automatically, the investors have dollars and so on. The key assumption is going to be the same as always in finance. In the end, if you make a promise on something, if I promise that yes, if you get hit by a high shock, I'm going to pay you the required income, I better have the income. I have to have proof somehow that that I'm able to do that. So I need some financial claims of my own, such that if I don't deliver when I promise, then you have access to my financial claims. So that's the problem with this, the potential problem with this shock. I'm going to use the blackboard for the most part just to try out, because I noticed that these slides can cause me to run over things or forget things. So we are going to go a case where consumers have the same consumption stream, value of consumption streams at 0, 1, and 2. There are 3 dates. So T equals 0, 1, and 2. And it's the same model as we have used before. Now this is going to be the timeline. So there is 0, 1, and 2. And we have an initial investment. We have this shock Z. And then we are going to have let me just write it down as a continuation scale decision. We decide based on the Z that hits, the liquidity shock that hits, we decide what fraction of the liquidity shock we are going to cover. So IZ is less or equal to I. And then, therefore, how much of the returns we are going to get, which is Z0 IZ for the investors, and then Z1 minus Z0 IZ for the private. So this is the private benefit, and this is the investors, or the liquid claim. So this is the model I'm going to be working over. I'm going to assume there are many firms. So let me say that there are 2 kinds of issues in the liquidity problem that we are going to have to address. One of them is that the question about is there sufficient. So 2 questions. Enough aggregate liquidity is the first question, which is this question of, in some sense, is there enough wealth in society to support the right savings instrument that implement the plan? The plan I'm interested in is the one where you go I and you continue with full scale of I, and this regardless of whether the low shock or the high shock hits. are there instruments for supporting that plan?
So, can I just
Yeah.
interrupt since you allowed it?
Absolutely.
Can you just step back for a second and tell whether we are still in moral hazard, where there is sort of an effort exerted by the entrepreneur?
Okay, good. So the idea of shifting into this model, I mean, yesterday I described this moral hazard problem. Let me just go back to this case. So this is, I gave you a story yesterday of why not everything is pledgeable. Because in order for Katja to be working, I am giving her money in order to get her to actually to not choose the wrong project. She needs to get some fraction or some minimum fraction of the return. That was the idea. And that gave this wedge. But then I said afterwards that actually, when all is said and done, there are a lot of ways to get the wedge. It may be that Katja always takes off, she doesn't, but let's imagine, 30% of the wedge. That's it. She just has the ability to dip into the pocket, and I have no way of preventing that from happening. Okay? So that's a theft story. Okay? And I know you are going to get away with it. Or then I gave a third story, which was the one where Katja is just, I know, she thinks it's 120. I happen to be pretty certain it's 80. But let her just think, that's social value. She thinks she's 120. This project should go on if she thinks it's 120. But I'm not going to put more than 80 in it. Okay, that's the third story. So this is your dreams rather than what you stole or the rent you need. So the thing is, it doesn't much matter which of the stories you tell. So I'm now into the reduced form, which I prefer just to simplify notation and so on. I mean, this is kind of the essence. In some ways, it is really important. And this, by the way, this kind of slice model is becoming much more used now because people realize it's just very simple. We can tell all sorts of underlying stories. The rest of the story pretty much continues the same regardless of what story you tell. By the way, with one exception, for instance, a dream story in a dynamic world, the dreams keep changing. So if it's a belief difference that generates this wedge, one has to be a little careful with the dynamic models. But otherwise, we are adults, we understand, how to think about it. So that's where I am. So,
yeah, my question is also similar. Yesterday you mentioned setups where Z is verifiable and
yeah.
some setups where you can actually pretend that it's ZH
Yeah.
or ZH.
Yeah, the shock.
The shock. Yeah, the shock is up to what extent the shock is, you will do this supply liquidity model to what extent Z is contractible.
Yes, Z is contractable.
So the question is not to
No.
pretend it's a different Z, but
No.
just to have fun.
This is all, I'm back into the mode again where this Z here is contractible. Yeah.
So the issue is to have
Just
funds to supply
yeah, it's
to
a,
cover Z.
I mean, it's a puzzle. Look, we are so used to thinking that the investors are rich and they have money, and so there is never a problem about getting the investors to pay. But by the way, we have a family business, and family business. In Finland, when the Finnish crisis hit, guess who we were nervous about? Whether the bank will be able to deliver on our liquidity needs. That's how bad Finland was in 91, 92. So it's not to be taken for granted that if somebody says, I'm going to pay, and the guy is rich, and Donald Trump, suddenly Donald Trump doesn't have the money, So you better, in some sense, be convinced also as the entrepreneur that whoever is behind it, in this promising, there are other problems about whether they will hold a commitment for other reasons and so on. But there's a real issue just economically that you better have wealth to back up these pledges. And that sounds like it's a problem people haven't thought about much. But what I have to show you that in some circumstances this is a real problem. And we do know that there's a big, this is not artificial, in that shortages of aggregate liquidity actually are significant in economies. So enough aggregate liquidity meaning just, is there on the investor side enough wealth to support this? And the key is going to be that our investors in the first stage, their wealth is from the very projects that we are looking to finance. So this is a closed economy where we are setting up these entrepreneurs. There's no other wealth for the moment. So, you know, we could of course just always do the CL, and you know, this thing would be running and this economy would be running, but we are looking at a case where we would like to do the CH. The CH is possible in the sense of, you know, from the borrower side. Now the question is, will the lender be able to provide the CH when that moment comes? And as I said, the kicker is the only thing that ever will back up the CH for the lender is these very projects that are around in the economy. So there are 100 or thousands of them. So you see, it's like a bootstrap, you know. Will these guys get financing? They will get financing under, you know, certain circumstances, but then will the investors have the support from these very projects to actually carry out this pledge to provide CH? So it's a kind of it's a question that certainly we haven't seen asked before. Yeah.
Isn't that the question whether there will be a system that would support the consumers to give up some of their consumptions in real
Yes,
terms?
so the issue is, they are consumers, by the way. These consumers, these are just all agents have this preference. But the idea is that they are consumers that have, yeah, good, let me emphasize, consumers have a lot of money. But there is an important assumption here, that, thank you. Consumers cannot pledge their human capital. You know, so this is not a fully closed model with income and so on. But the key is, consumers have money, but you cannot just go and ask the consumer. The consumers say, we'll give you money when tomorrow comes, but if you cannot, there's the idea that you cannot verify the income, or they can eat it before you get to it, or something. They cannot just go and promise. They have to have financial claims behind their pledge. Everything has to flow back to productive assets as opposed to just human capital. That's, in a way, you know, that's, by the way, another interpretation, Katja, of that wedge. It's not just the entrepreneur, it's all the rents that go to, you know, the firms, you know. So this, if you think this is not a very significant number, actually, when you think about all the rents for the employee, you know, it's a significant number. So the aggregate liquidity question is just whether this scheme in theory can go to work, we'll see. And then there's a question, a second question that relates to it. Aggregate liquidity is sort of what's the total amount of savings instruments if we had a complete market on the part that's white there, which is what's pledgeable income. And then the question is, can we use this efficiently? And in some ways, it's the answer to this second question was one of the big surprises, is that it's going to come out that if we have an aggregate shock, so there's a macro shock, every firm gets hit by CH at the same time, then CH can never be covered. It's pretty obvious, you know, because there's no wealth. I'll come back to that just in a second. It's going to be, the other part is going to be that when they are all independent, so that if there's a continuum of them, we can treat this as a deterministic amount of liquidity demanded tomorrow, because there are just so many shocks of them, so they are roughly deterministic. Then there's always aggregate liquidity if they are borrowers, but it will require, generally speaking, some more sophisticated savings instruments than, say, just the share of the total stock market or the value of the firm. That was actually I'm just flagging, this was something that we didn't think about, but when you look at it, you realize that that's the case. And so this is, by the way, what the book that we are writing is called Inside and Outside Liquidity. So this one way of asking this question, what I'm asking here is there enough inside liquidity? Does the corporate sector in its own generate enough savings instruments through these projects to actually make it sort of able to carry itself forward, implement the efficient plan? And then the answer is going to be that when the aggregate shocks, no. And then comes the question about, where do you get outside liquidity? And the outside liquidity, we'll come to that in a moment, that comes from government and other possible suppliers. Okay, so let me just say that, come back to this and see that if you look at this, so remember this piece here, NPV of continuation is greater than 0. NPV here of continuation for the investor is less than 0. So this is the problem. So investors will see this as a negative NPV if the shock goes in here, CH, and here it's going to be a positive NPV. So if everybody gets hit by this shock, so now we are to say aggregate uncertainty. So this is case 1. Then the answer is can't deal with CH. Why? Because once CH has hit, what is the continuation value? Suppose we can continue. What is the value of those projects net of the CH? Well, it's negative. The total value of the total that can be pledged to investors is this. So even then if we go with the I, it's going to go like that. But that's still C0I is not enough to get the CHI. So I'm just saying something obvious. C0 minus CHI is negative no matter what I we choose. So this is just not going to work. You're not going to get anybody. And the consumers cannot pledge because the only assets in town have a negative value. So wealth is 0 in a sense in this economy. I mean, this is an extreme example, but that's the case. So this is a case where you definitely need outside liquidity. And this kind of in a stark way illustrates what the problem we are talking about. So let's go and look at the independent case because it gives one more. So we do independent case. Then we have a situation that we are going to have. So this is the continuum quasi-independent. Gives you that the total value, the continuation value of total assets, and this is by the way mass 1, so it's all, whether we are everything looks the same whether we look at the representative firm or the whole economy. Continuation value of total assets, it's the Z0, it's the fraction PL times Z0 minus CL plus the fraction P8. Now they are fractions, they are not probabilities anymore. These are deterministic. Z0 minus CH. And this is positive, of course, and this is negative. Okay. But if I minus R, so this has to be greater or equal to I minus A, remember? And if this is positive, so we are looking at a situation where these firms initially borrow money. Then it must mean, this equation shows, that if they got the money, it must mean that the continuation value in aggregate is positive, because investors would never have lent to these guys had this been negative. Okay? So the guys might, so this independent case says the aggregate continuation value of the firms is positive. And so that's what we mean by saying that there's enough aggregate liquidity. There's enough aggregate liquidity to cover the demand for, what is the demand for liquidity? The demand for liquidity is well, it's right here. It's the PL, ZL, and PH times ZH. And the output is supply. So there is enough aggregate liquidity, but the question that's of interest is that this question has a trivial answer. It hinges, by the way, critically on this I minus A being greater than 0. So that's important to emphasize. But if you ask yourself, will stock market do, will stock index do, be enough? The answer is not necessarily. A stock index, what's the value of the stock index? The stock index value is C0 minus PH times CH. I'm sorry, the stock index value is this here. Okay? This is the value of the stock index. This is the value of the continuation, and so if we give everybody a pro rata share of the stock index, then we ask, is the stock index enough to cover the liquidity need of the fraction of the firms that actually need liquidity? The question becomes, is C0 minus PHCH minus PL, CL greater than CH minus Z0? So they need, this is what they need. Am I missing a T? PL. So Z0 minus CH. Maybe I'm missing a. Let me just see.
You're looking at that or exposed?
I'm looking at the exposed. I'm looking at the exposed. Well, let me just. C0 minus PL, PH times 0 PL, CL. I have dropped the i's, so CH minus Z0. Yeah. And the answer is that this could. The answer is that could be possible. Could be. Could not be or may not be satisfied. So while it is the case that there is enough liquidity, in the stock market, it could be still the case that if we all take a share of just the stock index, that share of the stock index will not be enough to cover the liquidity need that I have as an individual firm. So this is how much I need. This is how much I get from my little share of the stock index. And this is possible, but so is this. So this is a perfectly possible scenario. And so what's going on? This is the important thing. The important point is that what happens here is that we have waste of liquidity. In the following sense, this, by the way, forced us to think a little bit. We were puzzled by this. But what is going on is that if every company has, think of it that they are actually given some extra money so that they get a share in the stock index at date 0, if they have a share of the world, I have a 1% of the whole economy's projects, and every firm has 1% of the whole economy's projects, then a fraction of us will get hit by this high shock, a fraction will be hit by the low shock. The problem is that the guys who get hit by the low shock, they also hold the 1%, each of them. So yes, I get some of that money back through my 1% holding of the intact firms, or the firms at least that are healthy enough to continue, but they are sitting on liquidity, which they got at day 0 to protect themselves in case they get hit by the shock. And that liquidity is too late to redistribute at day 1 by some other means. So there will be healthy firms that prepare themselves for liquidity shock. They didn't get the big liquidity shock. They have extra liquidity. They have the, they have the C0 minus CL is a positive number, so they have that kind of cash that they could still dilute and get more liquidity. But there's no incentive for them to do that, notice, at that late date, in order to supply to the distressed firms. And secondly, they hold, each one of them holds that same slice of the stock index. So there's kind of massive amounts of liquidity that gets wasted in the sense that it doesn't get transferred to the distressed firms as it should. So the stock index as an instrument for providing liquidity is not a sophisticated enough tool. Basically the problem with it is that it doesn't take into account the idiosyncratic shocks. It doesn't distinguish between did you have a liquidity shock, a high liquidity shock, or did you have a low liquidity shock. Everybody gets treated the same way. They all have the same amount of liquidity exposed in the stock market. And what this second best scheme demands in general is that stock not enough, and what it says is that you have to have more sophisticated system. And more sophisticated here means credit line or something where somebody's got to be able to figure out whether you have the ZH or the ZL and actually pay as a function of that ZH or ZL. Yes?
Would an option on the realization of the shock be sufficient?
Yes, options would be options on the realization. What do you mean by it? Just
well, because once the shock is realized, some firms are more valuable than others. So if you
yes, the options on your individual shock.
Yes.
Yes. So that's an example. So fully state-contingent claims will be just enough. And any more but options. The key is that you got to get to that individual level, and that's the.
Option on the index would not work.
Yeah, the lesson here, by the way, this looks a little, because the model is so simple and stark, it looks, the general message is here, liquidity has these two, supply of liquidity has these two portions, one of which is that you have to have enough of a base that you can claim, that's a productive base you can claim. But you also have to have methods, to coordinate the liquidity use in an efficient manner. So let me take actually a practical example to illustrate a little bit what is happening. So let's take a sophisticated economy, supposedly United States. One of the ways in which I told you about the fact that the Chinese, this is a little different. It's about the Chinese and other people wanting to access American savings instruments, and America responding in this view by creating savings instruments. So how this is about how can we deal endogenously with this problem of not having enough instruments? What the U.S. does is basically it has two instruments. First, it has gone enormously large into home equity loans.
Sorry.
Home equity.
Chinese example is related to the case 1, isn't it?
Case 1 is actually this independent case was the case 2. Sorry, I forgot to write. The case 2 was the independent case. Did you say that you want an example with regard to case 1?
No. I mean that Chinese. You give us an example of Chinese policy. It seems like it is related to the case 1, and there is no reserves inside, no liquidity inside.
Yeah, well, I don't think it has the case 1. It's not so much, yes, it is that they are. This hasn't happened yet, so they appear to be worried about some shock, that they cannot cover when the day comes, maybe because they don't, it may be a different story where they don't trust, the government to supply the liquidity, or the government inflates things or whatever. They are worried about high shocks but the Chinese thing is, where this cake here, the corporate governance and so on, is so bad that this is actually much bigger. This piece that they can pledge for the entrepreneurs is very small, and that is. So let me go back to this home equity loan and give an example, that because this is interesting. Is the key here is that home equity loans is you own a home, you say built it, you own it, and your starting point in that sense is initially that you have this whole cake to yourself. Home equity loans go and say, well, don't keep the $1 million that you have in your house. Your house is worth $1 million. You have no debt. You feel very good, but the guys come and bombard you with proposals all the time, or maybe you need a little more money. And so why don't you take out a home equity loan, which means take out some debt and take a slice out of that. And the idea is, they are saying that rather than you keeping this all as private, make it into some marketable instrument by taking out a loan. And then the next step you'll see just in a minute. But the point is that debt is a savings instrument for the other side of the market. So the demand can come from the people who want savings instrument rather than from you could think the story the other way around. I have a house of $1 million. I feel like, I want to buy something, therefore I take out a mortgage, a home equity loan, and therefore I can buy something. But the other side of the story, that for me, as I want the consumption, it could be that the driver comes from the other side of the equation. So when they do the home equity loans, that comes paired with mortgage-backed securities. And this is the two parts of it. The home equity loan, when I take that out, I'm increasing the asset, what we call the aggregate liquidity, which is, the base of wealth that can be, used for claims. Here comes the part that makes sophisticated use of this base. They, rather than just have the equity loan and have the bank hold the equity loan, which by the way would act then as collateral for all sorts of loans that the bank does. So it would supply liquidity. The bank could then go and finance other enterprises, and they would say, we have actually something here, which is, we have a claim on Bengt's house. So that still works, but America has become incredible, the US has become incredibly sophisticated on these mortgage-backed securities. Which slice these they package them together, they slice them into pieces, and basically create what I think reasonably could be called almost a complete market of sorts. And that's the second part that I'm saying, it can be used this efficiently. It is this second layer that has made, maximal use, if you wish, from the aggregate base that we are starting from. You have to have the base, and that's the first question, but then there's also a question about how do you use the base? Because in different contingencies, you want, just like Jim was saying, you want to use options or some other more sophisticated instruments so that they are sensitive to these contingencies. And so both these parts are very important in terms of kind of making a market or an economy have a lot of savings instruments. But the interest is that sort of the slightly non-obvious part in some way, at least when one thinks initially, is that when people actually get themselves indebted, that is a service to the rest of the world. And if nobody gets, it's a version of this thing that if everybody saves, the economy will be very poor. Or very little will happen. This is sort of the financial equivalent saying, if everybody owns just what they have, this economy will have very little liquidity, and you know, will be very difficult to. So let me say, so this was one way in which you can actually address. This is kind of, it's a form of outside liquidity, which is, you know, bringing the consumer in to kind of create his or her own assets in order to supply more. There are other instruments. Let me talk for a moment about the government, which is so another place to look if we are in a situation where we don't have aggregate enough. So notice that even though the aggregate liquidity in the sense I described there, or wherever, you know, is short, could be short if there's an aggregate shock, you also have to use it efficiently, and when you combine the two, you can actually have situations where there's a shortage. Oh, I should very importantly, of course, say consumers have liquidity needs also. So, you know, we are just looking at the corporate sector. But when you realize the consumers have significant liquidity, you see that these shortages of liquidity are not sort of some kind of theoretical imagination. The best evidence is actually to just look at what happens to prices when more liquidity is provided than less. And as I said, the US, I think this is one of the reasons that you have seen actually interest rate very low, and has been this change in the savings instruments. So let me say a word about another. The government supply liquidity. And so one of the questions you can ask here is, the first question always when we talk about government supply liquidity, what can government do? So government can issue bonds. We'll talk about, or there are many other ways in which the government can provide liquidity, but one of the things we can focus on here is, in the simplest way of financial asset, government can issue bonds. In fact, government issues bonds just because it runs public finance programs. You know, so it raises naturally taxes, and so government bonds are a very significant part, of course, of savings instruments for people, and in this logic of the model that I'm talking about here, an incredibly important part of the provision of aggregate liquidity. If the key thing is that if there is a shortage, suppose there is let's go to the case where there is just an aggregate shock. So suppose shortage of liquidity because of aggregate shock. So now you have to have some outside liquidity. Then what I want to emphasize is get to the question that you can have liquidity premium. So Q, let's define that, or Q minus 1, let me first, Q is the price at date 0 of bond that pays 1 at date 1. So this is simply an instrument whereby you can transport 1 unit of a good, or you know, we can think of it as $1 perhaps, but there's no money here. 1 unit of a good at date 0 into date 1. And Q, of course, has to be greater or equal to 1, because we have the consumer preferences as C0 plus C1 plus C2. So if Q goes less than 1, then there will be just arbitrage. The consumers, you know, would just massively be buying these bonds and getting a free ride. So Q, if they have infinite wealth, you know, that can't be an equilibrium. So Q has to be greater or equal to 1. Q can be greater than 1. This is the interesting thing. This is so the same thing as saying that there is a liquidity premium. Why can Q be greater than 1? Because when Q is greater than 1, then no consumer will buy, because consumers don't need liquidity in our simple model. And there with those preferences, you know, there's no point in giving more than $1 at date 0 in order to get a dollar at date 1. You know, that's not you, because you can just as well consume that amount at date 1 yourself. So in a sense, you can, the consumer in that sense doesn't need any savings. Why can it still be bigger than 1? Because the answer is that because if there's a shortage of liquidity, and I'll go over and do the case just in a second. If there's a shortage of liquidity, firms are willing to pay a premium, potentially, to be able to cover the CH. We are in a world where CH cannot be covered because there are no savings instruments. Now I'm saying, what if government provides, bonds and says you can buy these bonds? Firms will actually at the margin buy more than, be willing to pay more than 1. And notice that because my interest rate is 0, what this Q greater than 1 means is just a negative interest rate. Okay? Well, of course, if I had run a model which would say there is a base interest rate, that's positive, then this would mean just that this, the price, the price of the bond goes up and the yield goes down, and it's suppressed below that baseline. But here the baseline is 0, so this means just that there's a negative interest rate. But the basic idea is these bonds are valuable and the yields are low. And why? So let's just look at for a moment on, maybe I should keep that up there since it has an equation. What happens here is that you just look, let me just write down the representative first, the budget constraint. I'm going to look at the demand for these bonds as a function of this Q. The budget constraints look like I plus Q times L. This is the amount of bonds purchased. And minus A. So the new factor here is that I'm not just investing, I'm also investing in liquidity by buying these bonds. That has to be less or equal to what I have to give back at date 1, which is L plus, again, this PLC0 minus CL plus times I plus PH, and then I put back the X, which was the decision whether to continue or not, I. So this is, the new change is that the bond purchase has come in and you're getting back the face value of the bond tomorrow. So you are the cost of this operation is this Q minus, so the cost is Q minus 1 times L. But otherwise it's just the same equation as we had before. And now the question is, of course, if I push up this Q, maybe I don't want to continue anymore with the X. So the X is this decision of what fraction to continue, which goes into 0 and 1. And what do I need to cover all? So L is less or equal, or less is X times C0 minus CH I. That's how if I want to continue fraction X, I have to cover this much. I get the Z0 from dilution, but then I have to cover I should write the other way around, CH minus C0. That's a positive number. That's the part that I have to cover with some external financing, which is the purchase of the bonds. And so you can put this back into the equation, but I'm not going to do any of the algebra. I'm just going to do a picture which shows you what does it look like, the demand for the bonds. So of course you understand that the higher the X is, it's the same trade-off as before. Then I can invest less because I'm spending more on liquidity, and the liquidity now cost me something real. So there's an additional cost. It's part of the input in producing in this new technology, and it's going to be the case that it's going to have the form that X equals 1 if Q is less or equal to some cutoff I mean, it's intuitively obvious. It's going to be 0 if Q is greater than some maximum value, and I could give you the expression of the maximum value. And then it's actually in 0, 1 if Q is exactly equal to the Q, the critical Q bar. So the point is that the bond price can be pushed up, but at some point, you know, when it goes high enough, these guys will stop buying. And if it's just at that price, then they are indifferent. You know, it's a point of indifference between buying or not. So that gives you a demand function.
Could you explain this?
Yeah.
Why should we consider this constraint with a probability 1? Maybe with some probability which is different from 1.
Where?
Yeah,
Where
I
am
mean L is equal to. You consider this.
Oh yeah. Oh, okay. So you wonder why isn't there a pH here or something like that? Is that it?
Okay.
Because this is when I am in the situation that I have found out that I am the CH guy, there is no probability anymore. So as a firm, individual, it was the same as that equation up there. Once I am the firm that has been hit by CH, this is how much I have to come up with from somewhere. Or this is actually what I must have arranged in advance, because I can get to the 0 by just diluting all the shares or reissuing my my original value. But this I must have, from outside. So there is no pH anymore. And so if x is 0, I don't need any. If x is 1, I need CH minus V0 times I, and anything in between. So
But this is again a non-contingent asset, and so there is a waste of liquidity as well. Right? If you get hit by a low shock,
I'll come back to that. So you mean that the issuing the bond that's not contingent? Absolutely. We'll come back to that just in a minute. I'll just show you what it looks like. So in this, if you have Q here, we are going to have a Q bar here, and initially this is the demand function. The way it's going to look here, it's going to be Q equals 1. Basically going to look like this, the demand for, and then eventually, there's a maximum amount. So this is the demand function. Why is this flat portion here? Well, this is where when you hit Q bar, I can go between 0 and 1 with X. So, this whole, I can be anywhere in here. So it doesn't, the Q bar, if you go above Q bar, it's 0. So it goes like this. But here is an indifference. And notice, by the way, as I go higher with X, I have to drop down the investment. So it has the odd feature that actually, as I'm doing this, I'm dropping down investment. Then I go down this section simply because it's going to cost, as liquidity becomes cheaper, money is released to actually increase scale. So I'm going to demand more of it. You have to look at the budget equation to get it. And when it hits 1, I'm back to the world where basically liquidity is free. So when Q equals 1, there's no charge here. I could just drop these L's from this budget equation and back in the world where I was before. So this is the way it looks like. Then that's the LD, and then there is, of course, in equilibrium, there's some supply function. So LS as a function of this Q. That's the aggregate supply function. And as I said, the aggregate supply function could come from these home mortgages. If it turns out that the demand increases a lot, moves up, these guys will start doing something. It costs, of course, by the way, to produce home. It's not free, these home equity loans. Somebody's got to work with them. You have to, sign letters. You have to have lawyers around. You have to do so. So if there is no excess demand of savings instruments, they aren't going to do it to you. So there's a production cost. So the point is there's going to be some upward sloping. If it's the government, which is what I wanted to discuss here, it's hard to say exactly what the government is going to charge, but it could be, of course, just that it's whatever, the market bears, and also considerations of the cost of government in terms of what the tax distortions are.
Yeah, that's exactly about tax distortion. So where does government get the money, and why it would produce those bonds instead of investing in this project, for example? Also.
Why? separate two things. One, yes, they could, of course. Are you thinking of something where the government would just say, look, I'm doing nothing today, but if you're hit with a high shock, come to my window and I will give you money.
Well, that's a possibility, even though I understand.
That's a good possibility. We'll talk about that just in a second.
But then also, I mean, maybe if the government wants to raise money at the end, maybe
Yes.
it's worth just, pretending that you're an entrepreneur and go and invest in the project instead of, issuing bonds which will bring you more.
Well, remember, this is all we got here. And we have concluded that these guys, we could invest more in the, there's only one kind of project in this fictitious economy. And it has the feature that if no outside liquidity is provided, I'm not going to be able to cover more than ZL. So the government could give money to additional projects, but that's a waste because they can get the money from that we know is a waste because they are just going to get it from the consumers. Because then they just need to cover ZL and that's not a problem. So that there's no purpose for that in this particular example. But one of the questions is, of course, is this a worthwhile exercise to notice what happens here is that if we have date 0 and we have date 1, then the government is getting money here, because it's issuing these bonds, people are buying it, so the government is indebting itself. Notice this is like the government, it's like the home equity example, except on behalf of the consumers, the government is now securitizing the future income of the workers. So this mechanism, in a sense, that's what the government is assumed to be able to do and nobody else is doing, which is it can go back to the consumers and actually go and tax them. So it's the taxing authority that makes this kind of feasible. It could, of course, outsource it and ask somebody else, or it could have some kind of system where people can commit their future income. But the tax system, since it's run in any case, it's a natural place to do. It's already operating.
But in this case, you don't actually need taxation, because since the interest rate is lower than the market rate, you can just take them, invest them in the interest rate somewhere, and just return them.
No, that's just saying how much money you are getting, more money than you would get if the interest rate would be 0. But you are issuing money, you are issuing bonds, and you are sucking up money from the consumers. They are paying, they are saving here.
Right. No, but what I'm saying is that you don't.
Oh, it's not consumers. It's actually the firm. But you are issuing on behalf of the consumers this debt instrument, and it's the firms that are buying. So money is coming in here.
The countries have huge reserves frequently. Okay, and the country having reserves and at the same time being indebted to its own citizens, it's a strange thing. But what you're saying is that it actually explains it. You suck out money out of the system, invest them abroad, and then when the system needs it, you bring them back.
That's too complicated. That's the next lecture. But it will not answer. Why? Look, why do they have reserves at the same time as they indebt themselves? Why does Nokia have both debt and sitting on 8 billion or 10 billion or whatever it is today? I mean, we don't. This has to do with very short-term liquidity issues and so on. That's not what we are trying to address here. So this is. They're getting money in and then they have to pay out. So here they have to tax. And here they are giving consumers, so this is tax relief they are giving, if you want to think of it that way. So the question is, here they are forcing consumers to eat more and here they are taxing. Of course, if Q is greater than 1 and if this is costless, this would be just beautiful. This would be just, yes, so the consumers will be enjoying this benefit. The reason, one could tell various stories of where this is coming from, that if there are tax distortions, then you would have to take into account the fact that the tax distortions probably get more severe, the more liquidity, the more you issue here bonds, the more you have to tax here. It's going to be a more expensive system, so you actually get an upward sloping curve of some sort. And in the paper that we originally wrote, we just assumed that that this is going to be run so that the consumers don't suffer, so that firms at least pay the cost. Let me just say one. Yeah.
I think it isn't. What you're saying is that entrepreneurs cannot pledge their human capital. Consumers cannot pledge their human capital.
Nobody can pledge their human
capital.
Exactly. So
this,
and therefore the government can pledge human capital. Okay. Exactly. The government can pledge income from human capital.
Exactly. So it
securitizes
workers' human capital.
Correct. That's exactly the interpretation. And of course it's doing it. I mean, our last escape route is always the government is legally the only one who can sort of commit future generations. Mm-hmm. You know, you people come and say, well, why can't individuals do and so on. And my answer is simply that, you know, there is a tax system, so we are basically free riding on the tax system already by doing this. Notice that the tax system, if we are doing an efficient level of taxation, it has deadweight cost and so on, but it has benefits. So we are at the equilibrium where the government has optimally supplied bonds. Then there are floating around bonds already. And those are, like Woodford pointed out, they are net worth, you know, they are liquidity. But if that isn't enough, there is sort of there may be a reason just for the purpose of liquidity to issue more bonds. And what I'm saying here is that you see that at the margin, the first extra dollar of liquidity that you issue is actually at zero cost, because you were just, you know, you were just netting out the cost of, you know, the tax distortion cost against the benefit from the social program. If that, you know, in that welfare calculation. So in that sense, there will be always some scope of issuing more liquidity. So now I come to Katya's question, which is a very good one, and that is that this, if there is a cost to tax, there is a cost to taxation. So there is a problem in a sense here in that why issue bonds? Sort of, there will be bonds. Notice that all the firms are identical ex ante, so they will all buy these bonds. And there's going to be a waste of liquidity because a fraction of these firms will not need these bonds. And they don't need to sell it. Actually, it turns out that if one studies this just as a social program, you know, this is assuming they are all covering it. If they have some mechanism of moving bonds from, you know, the firms that have not been hit by the high liquidity shock to the firms that have been hit with the high liquidity shock, then that way they are saving on these bonds. But generally speaking, there is a simpler mechanism for reducing the tax costs and still provide exactly the same service, and that's to provide a state-contingent bond. They could say just that this is, after all, an aggregate shock. So if the aggregate shock is high, we are going to... Oh yeah, so I spoke... Forget about, everybody gets, I'm in the world where everybody gets hit by the high shock. So let me just say this again. I forgot, I've lived in this world where they were both high and low. This is a world where either everybody gets hit by a low shock or everybody gets hit by a high shock. If everybody gets hit by a low shock, there's massive waste in the sense of this liquidity because nobody needed it. And so that leads to the state contingent bond idea. That why don't we just issue a bond that says if a high shock occurs, then you get back your money, but if the low shock comes, then you know, then you are not going to get any money, and I don't have to tax any of the workers. That's the bond. That's kind of the instrument you wanted. And so you can ask, why don't we see state contingent bonds? And the answer is, actually we saw state contingent bonds, by the way. In the year 2000, they got very nervous about massive liquidity problems as they go from the computers that only run up to 2000. You know, maybe people dream, I'm sure that it were the people who sold these computer services that drummed up this enormous fear that, you know, the world will come to an end and the sun will stop shining and, you know, God knows what they came up with. Nothing happened, but the government or the Federal Reserve was nervous enough that well, first of all, one reason they were nervous because they saw the spread of the bond go up. You know, the people were nervous because treasuries were trading at a much higher price, or the spread between treasuries and say corporate bonds really grew significantly. That's a sign that people are nervous about some singular event, and in this case it was obviously 2000. And they could see actually that it was just about a week around the turn of the millennium. And so they issued call options. They said that, you know, if you need liquidity on January 1st or January 2nd and January 3rd, they had, I think they had 10 days covered, then we have markets for it. And they opened up markets and people could go, and sure enough, a lot of people bought. And the spread was, I think, like 1.5%, which is a, you know, I'm wondering whether it's an annual, you know, the rate is like an annual rate or something like that. But it was significant enough, the cost, and there was a lot of buying. That was a state-contingent bond because it delivered, or it was an option exactly, as opposed to, you know, some bond that you could always redeem. So you could only redeem it had sort of value only if the catastrophe would happen, it says. So that's the one example we have. But there are a lot more, let me just talk about it. There are a lot more, a looser interpretation, of course, says monetary policy is like a state-contingent bond. You know, you issue bonds, and then if you want to really inflate the value of the, you know, if you want to make it cheaper for these guys, you go looser policy. If you want to make it more expensive for the guys, you go tighter policy. So, you know, monetary policy actually matches exactly this, this logic of a state-contingent bond. And if you look at, for instance, Finland, which you have no particular reason to look at, but I have had a reason to look at, it turns out their devaluation policies have been exactly, in my view, that sharing. You know, they have derided the devaluations in Finland. It's funny, you know, they look at a country like Finland, it's in the top 10 in terms of growth and all sorts of performance indexes in the last, since the 1950s or something like. Japan, Finland, you know, Finland may even have gone past Japan by now. And yet they look at the same time and say, well, it's really managed because they had a terrible monetary policy where they devalued. Well, my view has always been that was a beautiful policy. In those days, when there were no financial markets and very little liquidity sort of from the financial markets, devaluations is a way of doing exactly what's described here. It's a much more complicated mechanism, it has other problems and so on, but the bottom line is, when corporate sector needs, especially in this case the export sector, needs money or funding, then the government, through the devaluation, is basically taking from the people who are ideal poor and wealthy, you know, otherwise the old men and ladies, and give it to the ideal rich, capital poor entrepreneurs, which are, you know, the people who run the company. So it's a way of, that's what this policy is about. It's about this risk sharing is, the bottom line of the risk sharing is move capital to entrepreneurs when they need it. And the other way around when they don't need it. That's the insurance scheme behind this whole thing of the contingent bonds. And that lesson, by the way, whether you do it through monetary policy or something else, this whole idea that this is a risk-sharing problem, which really dates back to, you know, Diamond and Dibby, I think it's very fundamental and very important, and a perspective that is, I think, gaining increased acceptance. So when is this? 10. Okay. So let me say then. Now I'm going to, given how little I have time, let me just say that. Say a few words about liquidity asset pricing. In a way, this Q greater than 1 is a liquidity pricing thing, of course. This is saying that Q will go above 1 when there's a shortage of aggregate liquidity, and it will push up the price of the asset and down the yield. If we look at, we can get a whole liquidity asset pricing model by using, maybe I just go through the simplest case. we have a paper called LAPM in an effort to make it to ride on the famous CAPM model. So that's how you pronounce this. It's a liquidity asset pricing model. And the idea is of this story is that corporate finance here affects actually asset pricing. As you saw, it comes from this liquidity premium. And that's just an unusual direction of thinking about things, because I said 99% of finance is about showing that when you price assets, you also have your corporate finance problem solved. That's of course not true, but that's what the books look like. They are all based on capital asset pricing model. And in this model, importantly, the supply of assets affects price, which is, of course, something that is in neoclassical economics. But again, if you go into capital asset pricing or any of the asset pricing models, supply of assets there's no effect. There's nothing in aggregate that's coming along, and this is just priced by arbitrage. There should be no effect. So the very fact that when you have this supply of assets, like we saw, another, by the way, proof of this importance of the supply is that the government, when they were running a surplus under Clinton, they planned to retire all of their 30-year treasuries, which is a really big benchmark asset, liquidity service. And you could just see how the spreads went up. There's a paper by Arvind Krishnamurthy, who is a student of mine. I mean, you get just very compelling evidence that people are using these things to basically protect themselves against some sort of risk. What exactly that risk is it the age shock? What that age shock is, we don't know. But notice that the nature here is that these are rare events. The age, I could have put 50 states and have just one age and still gotten a liquidity premium on the shock. If you get a state where people want to continue but there isn't supply, that asset is going to generate value. And that's, I think, what the government is uniquely positioned to do in terms of protecting people against very rare events. So we have this safe claim that generates Q minus 1. What this does is just what I said about the contingent claim. The Q premium is entirely coming from the fact that the marginal value of liquidity is greater than 1 in the high state. In the low state, it's just 1. So if you look at things from a typical, Arrow-Debreu state pricing point of view, we can write Q minus 1 equals the probability that the low state happens times ML, which is 1, plus PH, which is probability of high state, times the liquidity service value in the high state, which is MH. And that is generally greater than 1. And so you get Q minus 1 equals PH, this is 1, so it's M minus 1. This is the equation that ties the safe claim value to actually the service value in state I. And you can reverse it, because if we see Q, we can read the MH out of this, in this simple model, in this fictional model. So we can now get the price for this liquidity service in state H, and therefore actually right away for any asset in this whole economy. So we see that using MH, we can price any risky claim, and a natural way of describing the pricing is just to say how much does it deliver the risky claim. And I have used, just instead of C1 as usual, I just used general income streams, pledgeable income streams. The asset J is PL times what it delivers in state L, plus PH times what it delivers in state H, times the price. This is just standard Arrow-Debreu. And we, just as a normalization, we divide it so that everything is per unit of expected value that it delivers at date 1. So then I have rewritten this just a little bit down there. So this is just standard asset pricing. In the two-state case, you can see that one of the peculiarities, if one wants to, is the ratio of these things are just a function not of the probabilities, but just what they deliver in the high state. That's sort of the differential price of the assets have to do only with how much they deliver. And they said one of the implications is you know the bond price, you will know the price of all the other assets, and they all move in tandem in this two-block. Let me point out here that you can also price claims that demand liquidity in the highest, and so that's where we started. You know, somebody demands liquidity. So this is the case where Z0 is less than ZH. These were for general claims that have, you know, Y distribution, so they could be positive, they could be negative. If they are negative, as they were in our original setup here, then we have a liquidity discount, which goes usually under the name of an equity premium, or at least we could interpret it as an equity premium. Let me just point out that that looks a little puzzling. I remember I just said that if Q goes under 1, consumers will jump on it because of these preferences. So how can a price ever go under 1? I just had told you it never goes under 1. Well, this price is to be, this statement is to be interpreted as follows. That the price is less than 1 once the price can go less than 1 because it comes with a liability. The part I haven't showed here is the liability that when you buy this for 80 cents, say, you know, today, for every dollar of expected return tomorrow, that's actually 80 cents today, plus the commitment to provide liquidity in the high state if it happens tomorrow. You see, so it's not just you're buying this whole firm, so to speak, with the attendant promise to actually supply liquidity tomorrow. So that's how, it turns out that the guy gives $1 for the dollar of expected return. This is how much goes into investment. The balance goes into, you know, a self-claim that will. So I'm pricing only the sort of return part, not the liability part, which is maybe, you know, reasonable or not reasonable, but this is how these formulas are to be read. So that's what's saying here. Let me just say that there is a, or maybe I shouldn't say anything more. Let me say one thing. The general, yeah.
Is it that price of that liability, they need to invest more in the intermediate state? Is it endogenous to what's going on in the financial market, yeah, or what instruments are available?
Yeah, so let me then, now you said just enough that I want to show. There is actually, this hasn't been published anywhere or written up anywhere, but there is a general case. One of the nice features of this model is that you can actually do a complete equilibrium analysis. You just can go completely general about the state of nature. All this, not just Z, but Z0, Z1, all these things can vary with omega. And then you can decide, you know, something as a function of omega. You know, the IJ sub, you know, that's a function of the continuation investment as a function of omega. In fact, you wouldn't have to have the linear model, even you could go more general. But what in the end you can do is to say there are going to be some service values in each state of liquidity, service values in each state of omega, and then you can look at this problem that the firm solves. The problem solves maximize the net utility for, or the net rent for the entrepreneur, subject to the budget constraint that now looks such that you are looking at how much liquidity do you supply or demand in each state, which is this piece here, times the value of that supply or demand. So this is just like a consumer problem suddenly. Where either you supply or you demand, and here is the price, and here is the quantity, and that has to be greater or equal to I minus J. And rewritten, it looks like this. So you decide on your initial scale, you decide on how much liquidity you are going to, positive or negative, are you going to supply in each state. Here now is suppress the fact how you deliver it, you know, then you have to solve this problem. And subject just to this same rewritten constraint here. So the point that, why am I writing this? Because it's pretty easy to show existence. The optimum will be, the equilibrium will be optimal. And the state prices are going to be determined by, this aggregate liquidity. Notice there's no liquidity constraint here because everything has been priced in this equation. So this equilibrium condition here, that what's the aggregate demand for liquidity has to be equal to the aggregate, this is an external supply of liquidity, that has to be satisfied. So you are right that, one of the features here is everything, how much liquidity you supply and demand, it depends on what investments we do. What investments we can do depend on how much liquidity there is. And this is, if you get nothing else from this slide, the point is just that we have solved the whole, there is a perfectly bona fide standard kind of consumer equilibrium that determines that it exists always, and well, you have to give some conditions, but existence can be proved, and you are going to also get that it's optimal. And that's and you end up, the bottom line is you just end up in the general case. This is again the same. That's the asset pricing formula that you get from it. I was going to talk about the risk management that also comes from this model, but I won't do that. Let me just say that the Lappen formula, it's not, of course, going to be as significant in any sense that the Lappen formula, but one of the things is, you see that the Lappen formula tells you, it actually instructs you, the firm, to provide liquidity. You see, the problem I was solving is how much liquidity should I ask or supply in various states of nature. That's the same statement really as saying, what kind of securities should I issue? So or what kind of repayment policies should I be, if I'm Nokia, should I think about, if things go the following way, should I actually be, paying back, buying back my shares, for instance, that is, give back, money to the consumers. So it's about the question about how much money goes in and out of the firm as a function of this, and this all gets solved by this. And it depends in this story very much on the question about how scarce liquidity is, obviously. So you can kind of go, and we do go into looking at what kind of technologies are being run. So let me just give you an example. If liquidity is scarce, what you see is you see much more short-term projects because we are trying to build up liquidity. You pay less attention to private values, that non-pledgeable part. So, it has implications, and when you think about what poor, that's why I asked, I think yesterday at lunch, I asked how long are your mortgages? Because one of the things you see, emerging markets, they start off very short. Financing is very short because they want to have repayments quickly, because that builds up, the aggregate liquidity in the economy. And then when they get going sufficiently well, they can start financing longer term projects, and when the scarcity of this liquidity goes down. So this has kind of it matches well the practical implications. Again, none of which you get out of a standard asset. The standard asset pricing world is always at the bliss point from the beginning. There's nothing like this going on. Okay, so then the last lecture is going to be actually mainly focused on a different paper, a slightly different setup, which is this paper by Caballero and Krishnamurthy that deals with this international, the question of why can't we just go to the external world and get our aggregate liquidity needs supplied.